Welcome to the Workplace Savings and Benefits webinar on understanding retirement options. My name is Jonathan Stapleton, editor of WSB. The complexity facing those approaching or at retirement is increasing significantly as the result of both COVID-19 and yet more regulation. COVID-19 has led to some deciding to retire early due to redundancy, while others may need to work longer as the pandemic has squeezed finances. Yet others are looking to access their pensions early. On top of this, the way in which individuals can access advice on defined benefit transfers is changing. From October, contingent charging will be banned and a three-step model will come in. Going forward, members will either have the option of non-advised triage guidance, abridged advice, or full advice. This webinar will look at how scheme sponsors and trustees can ensure both defined benefit and defined contribution members understand their options at retirement and that they are getting the guidance and support necessary to make an informed choice. Joining me to discuss the issues involved are Wealth at Work Director Jonathan Watts-Ley and Pensions and Retirement Specialist Nim Maradas. Welcome both. Now, before we begin, I'd just like to remind everyone that this is an interactive discussion and you can send us your questions by using the Ask a Button question on your screen. I'll put as many of these as possible to our panelists, so please do ask away. If I can begin by just asking each of our panelists to briefly introduce themselves, please. First of all, Jonathan.
Yeah, good morning, everyone. Jonathan Watts-Ley from Wealth at Work. So this morning we're hoping to have a very open discussion regarding some of the changes that are afoot because of the change in regulations around DB, but also put that in the context of retirement, and one can't get away from the backdrop of COVID, so what the impact may be of that. So look forward to lots of questions.
Thank you very much indeed, Jonathan. Nim.
Good morning. I'm Nim Maradas. I'm a trustee at the Pearson Pension Plan, which is a £4 billion scheme with both DB and DC involved, and a lot of different sections, a lot of detail. But I have a slightly unusual background for a pension trustee in that I've been an IFA, so I have personal finance experience. I was for a long time a journalist at the Financial Times. And I've also worked for the FSA and FCA, so I know a little bit about regulation. I should stress, though, that I'm speaking here in a personal capacity, bringing to bear my experience on these very complicated and difficult questions.
Thank you very much indeed. Well, on to our first question, which is obviously COVID-19 has affected retirement decision making. To what extent are you seeing an uptick in early retirements or people deciding to work longer or looking at other options to access pensions early, for instance? Nim, can I start with you on that one first, please?
Yeah, I mean, I think anecdotally a lot of people are still in a holding pattern. There's so much uncertainty around, and a lot of people who are currently working really don't know what the future holds for them. I mean, we're beginning to hear about redundancies in various sectors, which are clearly going to push people to retire earlier than they're expecting to. And I noticed this morning there was some news, for instance, from the local government scheme of a consultation whereby there would be an adjustment to the way that pensions and redundancy payments would interact. So for some people, it's definitely going to precipitate decisions in a way that won't necessarily be very comfortable for them. Other people may find that they need to postpone their retirement if they can, because they need to work longer to build up enough funds. But as far as our scheme is concerned, I think the main thing we've noticed is members looking for reassurance that the overall value of their pensions, the security of their pensions, is unchanged so far. And maybe that some of them are rethinking their retirement plans, so they may be putting their round-the-world cruise on hold, but they're thinking about buying a motorhome instead. So I think it really depends on people's circumstances, their employment position, their overall financial position. So I don't think yet it's clear that there's an overall trend.
Thank you very much indeed, Nim. Jonathan, do you agree with that? I mean, is that sort of reflection of what you're seeing also?
Yeah, I don't think there's any clear data yet as to what's happening. I think there's anecdotal evidence around all those sort of three potential options that you mentioned. In terms of the older age range, for those between age 50 and 64, according to the DWP, there's about 2.2 million that have been furloughed. So I think it is reasonable to expect, given all that we read in the newspapers, both in terms of redundancies that have already been announced, but also those that a lot of people fear will be just around the corner, that clearly there will be a lot of people in that age range who are possibly on furlough at the moment, who will need to think about their next steps. I mean, we have seen impact already, certainly at a household level, because of course, just by the fact that someone in the household may be on furlough or indeed may have already lost their job, we've already seen that there has been people raising questions about whether they can access their pension basically as a supplement to their household income, not really anything directly to do with retirement. So I think that in itself is a big issue, because of course for a lot of people, clearly if they've got other savings, then it may be better to look at other savings before they start looking at their pension, because otherwise they are potentially going to be wearing down that pension possibly a few years before they plan to retire. So I think that's right. I think we've got to wait to see how things pan out, but I think that we're probably in for quite a rough ride.
Thanks, Jonathan. You mentioned earlier, obviously there's also been an increase in regulation too, notably the way in which individuals can access advice on DB transfers and how that's changing. Can you just talk us through some of those changes that are coming into place and how this might change things for individuals?
Yeah, so the big change that comes in on the 1st of October is the ban on contingent charging. So I'm sure a lot of the audience will be very aware that this has been an ongoing debate actually for a number of years now. And of course, the debate always was that if an advisor only gets paid at the point that a transfer goes ahead, then surely that influences perhaps the advice that they will give. And even though there was research done, and in fact the FCA themselves didn't find a direct link there, I think there's always been a concern that there is a pressure point there. So what they're saying is from the 1st of October, an individual will need to pay for that or that advice will need to be paid for. In fact, it doesn't necessarily have to be paid by the individual. It could actually be paid by the scheme or indeed by the employer. But the point is that does have to be an upfront charge. So that's really going to change the landscape quite considerably, because of course for a lot of people to go and get DB transfer advice historically, where maybe they haven't had to write a check up front, I guess is a much easier thing to do than if you're asked to pay a check up front, which might be £3,000-4,000 is probably the rough guess as to how this pricing is going to work out. Then clearly before you write a check, you may have second thoughts as to whether you want to go through that process. And people clearly need to be aware as well that if they go through that process, they write that check, and then they get an answer which is you should not transfer. People may feel a little bit aggrieved that they've paid a lot of money for an answer which they didn't particularly want. But that is the world we're going into now. There are a couple of other things that individuals and indeed schemes and employers can think about. So the first is what's known as triage. So this is really where you're providing education to members, but in a very balanced way around generic pros and cons, if you will, of transferring. So that's something that could be done by schemes and employers, but it does have to be balanced. There can't be any indication one way or the other as to whether somebody should transfer. So it's a very generic, very balanced approach. But I think that has a role to play, because I think that if people understood the generic upsides and downsides, that would act as a sifting tool in its own right. The other thing that they could do, which again is a new thing coming in on the 1st of October, is access what's called a bridged advice. So a bridged advice is, if you like, a simplified form of advice. It still has to be signed off by a pension transfer specialist, but unlike full advice, it's limited in its approach, and it can only have 2 outcomes, and those outcomes are either that you should not transfer, or that there's not enough evidence to say one way or the other. And so if somebody did think, well, they still were thinking they might want to transfer, they would still ultimately have to go to full advice, and therefore they would still have to pay an upfront fee. So in essence, there's 3 different approaches, if you like. There's triage, which is generic. There's a bridged, which is specific but limited and has limited outcomes. And then there's full regulated advice, which ultimately you would have to get if you wanted to pursue a transfer.
Thank you, Jonathan. Just one question, if I can put it to you, Nim. There are obviously, despite sort of the general feeling out there that transfers are never in the best interest, there are some cases where transfer may well be a good thing. To what extent do these new rules make these sort of cases even more difficult, but both to find advisors willing to advise and also turn them around quickly enough in potentially very difficult times?
Yeah, I mean, I think generally speaking, trustees have been concerned that there have been too many transfers, that maybe people have been blinded by the large amounts of money that are available and may not have really understood the implications of the risk transfer in moving their money out of the DB scheme. But we do come across cases, and they're often very sad ones. For instance, if somebody is diagnosed with a terminal illness and doesn't have any dependents, so there wouldn't be a dependents pension or possibly life insurance payout. And in those cases, financially, on the face of it, it would be very beneficial to transfer out. Now, it's become more and more difficult for people to find financial advisors who are able to do this sort of work, who are willing to do this sort of work. And I think these measures will potentially make it even more difficult, will squeeze more advisors out. And there's, of course, the insurance aspect as well, where advisors find it difficult to get insurance to cover them for professional indemnity. So the whole thing is getting a lot more restrictive, and that, although I think trustees generally would be happy with the thrust of the FCA's moves, it will leave, I think, a few individuals, but individuals in very difficult circumstances and their families actually potentially worse off than they might be.
Thank you, Nim. Just moving on to a quick question we've had from one of our audience. I'll pose this to you, Jonathan. Do you absolutely always need an IFA to approve encashment of a DB pension? One for you, Jonathan, if I may.
Well, you need any DB transfer. It's not only that it's an IFA, but actually the really important thing is that it has to be a pension transfer specialist. So they have to have the appropriate qualifications. So this is one of the issues I think we've seen in the past, which is where individuals often know that they need to go out and get advice, but often they will go to an IFA, but that IFA will not actually be qualified to do the transfer anyway. And so we have seen cases where what happens is the IFA then goes and employs a transfer specialist to sign off the transfer. But of course, what you're doing all the time is you're just adding to costs for that individual, which is why it is increasingly important that trustees and employers try and help support members by getting regulated advice firms that have all the appropriate qualifications. And actually, there are other benefits, because where trustees and employers do this, they can negotiate preferential rates with contingent pricing coming in. It will allow them to do a preferential deal potentially as well. So it's really important actually that the right advisor is chosen. So it's not just about being an IFA; it's about being a pension transfer specialist.
Thank you, Jonathan. And it's just sort of following up from that, sort of moving to a more broader sort of question. How do you think trustees can ensure both DB and DC members understand their options at retirement, and make sure they're getting that sort of guidance and support necessary to make an informed choice?
I think the key thing really is that there is getting that education process. It's making sure that people understand what their options are, and I think this is one of the big issues, is that a lot of people will have a mix of DB and DC anyway. They will often have other assets, and they need to look at all of these things in the round. But understanding high level what options they have available really can only come through an education process. Now, after somebody's had education, they understand what options they have, both within the scheme and stuff that they may need to do outside. Then they may then want to go on and get regulated advice in any event. Now, as I said, for DB transfer, they would have to do that in any case, but they may want to do it to look at their whole retirement plan. So again, that education, guidance, advice process is a really, really important one to put in place. And I think it is trying to change the mindset really, from what are employers or trustees doing, so they, if you like, they tick their own compliance boxes, so that they do the bare minimum that they're required to do, versus which ones are actually showing best practice and really going for this goal of good member outcome at retirement. Because I think that's the key thing really. There's the one thing that we should never forget is that members save diligently into their pension scheme of whatever type for 30, 40 years, but the decisions that they make at retirement can, if you like, undo all the marginal gains of a very well-run scheme that you've contributed to for 40 years. So those decisions at retirement, we should not underestimate them, because they can cost people dearly. I mean, not least because we know of things, you know, the real extreme where people get scammed out of their money.
Thank you, Jonathan. And Nim, would you agree with that? Is that sort of your experience? Is getting that education process in place is key here?
I think I mostly agree, but I mean, when you strip it down, the trustee's job is to look after people's money and to pay the benefits when they're due. And not all trustees have either the powers in their trust deeds or the resources to go very far beyond that. I mean, I think trustees are very conscious how difficult all this is for people. And I've had experience on the helpline at TPAS, which means I'm certainly well aware of it. The extent to which many scheme members are completely bamboozled by the various options open to them is really extraordinary in some cases. So I think my heart is with Jonathan. My head says that trustees can probably be expected to understand and signpost information, and obviously that scheme administrators who people are in contact with need to know how to do that. But I do think an awful lot depends on employers as well to be supportive of this. I don't think many of them are taking up the option to allow people to take money out of pensions in order to pay for advice. I don't think many schemes are doing that, and they would almost certainly have to change scheme rules to do it. And I'm not sure that many companies are even aware that they can pay £500 towards advice. I think that's right. Jonathan will correct me if I'm wrong. And it can not be regarded as a benefit in kind. So, yes, trustees and schemes do need potentially to do more, and I think they're probably going to be forced to do more before too long. But it's not that easy for them always to take those steps.
Thank you very much indeed, Nim. On that question, we've had a couple through from our audience, and please do send your questions in. We'll get through as many as we can. With regards to our whole thing about employer support, what are the employer responsibilities, if any, towards their employees in terms of DB and DC pensions and making sure people get the best outcomes at retirement? Sorry, to you, Jonathan.
Well, I think this is the issue, isn't it? Is that there's a duty of care that they certainly have for making sure that they describe what options are available. So that has to be done, but that doesn't mean that people understand it, and it doesn't mean that they know where to go to get additional support. So I think this is really where the issue is coming up. So if you take DC for example, then high level, it's easy to say, well, you could just cash in your pension, you could buy an annuity, you could go into drawdown. But for most people, all those things, without really understanding what they mean, they're all fairly meaningless things. And we know people do crazy things. We know people cash in pensions and pay a load more tax that actually in reality they probably don't need to pay. We know that often if they want to go into drawdown, and of course this is one of the things that the FCA has been very concerned about and has also changed the rules on, that people just transfer into cash. Well, of course, if you transfer into cash and you're going to live another 25, 30 years, in real terms, you are going to be losing a lot of value. So it's not the right thing to do. So I think that these are the some of the sort of basic principles, if you like, that people don't understand. And another one is actually the fact that assuming you don't buy an annuity, and of course a lot of people these days are not buying annuities, then over 25, 30 years of retirement, income requirements are going to change, but you do not have a crystal ball, so you do not know exactly how they're going to change. But what we do know is that during that period, in some years, expenditure will be higher than other years because the boiler breaks or the car breaks down or whatever it might be. And then, of course, for some people, as they get into older age, actually costs will change because of the requirement of health. So that might mean getting daily help or something like that. And so, in the way that people manage money in retirement, even though they can't make all the decisions, and they shouldn't make all the decisions up front, they do need to be aware of, if you like, the variables that are likely to change, albeit they don't know how they're going to change over time in retirement. And this is why retirement products, it's so important to have some sort of understanding of them, because otherwise people can end up in products that are just not really suitable for actually how they're going to be spending money during retirement. So it's not just the decision, it's not just understanding what the options are at retirement, but it's also trying to have some sense of actually how might that flexibility need to work as I go through retirement. And that is why some people say that actually advice is a crucial thing to have, because you need actually ongoing regulated advice throughout retirement, because of all these things that may happen but are to a certain extent unknown at the point you retire.
Thank you very much indeed, Jonathan. Quite a few questions coming through. Can I take this one again for you, Jonathan? Our default DC arrangement is drawdown, but employees don't understand what to do with this, and most end up taking cash. They're reluctant to pay for advice or indeed take the advice. Our trustees would like to signpost drawdown arrangements and have incorporated the 500 advice allowance into scheme rules. Is this acceptable? Is this an acceptable approach to signpost the drawdown arrangement and so forth?
Yeah, so the drawdown arrangement in your own scheme clearly you can talk about that and explain it to people so they understand how your scheme works and how drawdown within your scheme works. The key thing is, though, is for people to understand that it's not the only option. And I mean, this is one of the other concerns is that where schemes do have defaults in place, one of the concerns is, is it right for that individual, or are there some other options outside the scheme that would be better for an individual? There has been some concerns as well also about some of the investment strategies, because some of the investment strategies that have been put in place really look more like accumulation investment strategies and decumulation investment strategies. And then, going back to my previous point, what happens as you go through retirement, and in some years you might need more money or less money depending on what's happening. So how do they adapt for that? So there's nothing wrong in clearly saying to your members, hey, here is a default strategy that we have, this is how it works. But in the same breath, it should also be very, very clear that it may not be the right option for that individual.
Thank you very much indeed. One of the issues often raised when we talk about guidance for members is that boundary between guidance and advice. And I think sometimes trustees report they're a little bit nervous at sort of the differences between the two. To what extent do we need more guidance, do you think, Nim, from regulators as to what trustees can actually tell members without straying over that line into advice?
It's a very difficult area for trustees, and there is an awful lot of guidance out there. In fact, in a way, we don't need, I would say, more guidance. We need clearer guidance, potentially. But it's extraordinarily difficult. If you listen in to the phone calls to any pension scheme administrators, at some point or another, the member will say, "What do you think?" And clearly, that's not a question that people can answer. What I am slightly concerned about is that the more that the rules and guidance are elaborated, in a way it gets more and more difficult for trustees to be supportive. So there's certainly a view that proposals which are out there now will mean that trustees can't provide a transfer value calculator, and couldn't, for example, put transfer values into benefit statements if they wanted to, as a matter of course. Now, there are arguments pro and con on both points, and I'm not sure that personally I would be in favour of either. But the boundary being so strict is also quite restrictive for trustees. There's no simple answer. If we'd found it, if there was one, we would have found it already. I mean, I think this is, maybe Jonathan has something to add here, because I know the way that Wealth at Work works, you do offer both propositions and you can move people from guidance to advice. But from the trustee point of view, this is genuinely difficult, and I don't think more guidance is what we need. We need clarity and lots of good practice guides.
Thank you very much indeed, Nim. Jonathan, would you agree?
Yeah, so I think this is an issue, and Nim's absolutely right that there is another consultation. Well, in fact, the consultation finished. I think it was on the 4th, and we're not going to see the results until, I believe, the end of Q1 next year. But yeah, around actually what can trustees do, and this impacts what goes on statements. It impacts the use of pension modelers because of this interpretation as to do they kind of, if you like, push an individual down one route rather than another. So again, are they balanced or not? So we're going to have to wait to see what happens from that consultation, which is, as I say, probably about 6 months away. But as a more general point, then I think Nim is right. It is very, very difficult for trustees to draw that line. We try and simplify it for people to say the best way to think about this is that if it's something you could do, then it's guidance, because it's saying you could do this, you could do that, you could do the other. So it's not specific. If it's saying you should do something, then you're being very specific, because you're implying that for that individual, this option or this course of action is better than another course of action. So the could versus the should is maybe an easy way to try and kind of remember it. But ultimately, there are these areas of grey, and that's why, as Nim points out, as an organisation, we offer guidance and we offer regulated advice, because when we get those telephone calls, and similar to what Nim said, the telephone calls that the trustees get, depending on what the question is, we can either say, yes, we can answer that on our guidance helpline, because this is around what you could do, so it's describing options generically, upsides and downsides. Whereas if they're asking very specific questions, which is very personalized to them, that's when we say to them, well, look, you're now asking questions where you need regulated advice, because I cannot give you a black and white answer to that question. So again, that's why sometimes having support in place through a third party can be helpful, because it basically you're then giving it to the third party to make that distinction, and of course it's a better experience for the member as well.
Thank you very much indeed, Jonathan. A couple of questions are coming through. With regards to what goes on statements, Jonathan, you mentioned whether one of our questions asked whether transfer values should be going on to retirement statements. Nim, can I ask you that one? Should retirement transfer values be put on retirement statements? I know it's a controversial one for trustee boards.
Personally, I think not. I think partly this is perhaps slightly paternalistic, in that I think if you show people the incredibly huge value of a good DB pension, they may be blinded by the huge number and not really understand the implications of the risk transfer if they do move it out. I think you could also lead to a lot of disappointment if people see a large number and then realise that they have to get regulated advice and it's going to cost money, and they then get advised not to move it, and they then don't know what to do with the money once they've got it. So there's potential for disappointment, but I do think there's also potential for conflict of interest, because the circumstances where I can see trustees being, if you like, keenest and certainly supported by employers to do this would be where a scheme is underfunded and where the commutation factors mean that transfers out, although they have to be demonstrably actuarially approved, there are cases where the factors would result in at least a small improvement in scheme funding, and I think there's potential for conflict of interest there, and such a mismatch between the information available to the schemes and the information that's available to members that I would tread with a lot of caution before they were put on as a matter of routine, even if the operational issues could be resolved, and those are not negligible by any means.
Thank you very much indeed. Jonathan, do you want to add anything to that at all?
Yeah, so my view on this is that, again, the balance, so this really goes back to educational triage, is clearly it's important that an individual knows that they have the ability, they have the option to transfer. So but I think that if you just put transfer values on without any other context, then of course, again, because often they can be very big numbers, all the member sees is the big number, and that becomes all consuming. So it does go back to this balance that I believe that we need to talk about it as an option, because let's not forget, if people, and there have been plenty of examples of this, if people do not realise that transferring out is an option, and it is actually right for them, maybe because of life-limiting illness, for example, then clearly that is not a good outcome for that member. So again, I will go back to educational triage, and it should be talked about, but it should be talked about in a balanced way alongside other options, and people generically knowing the upside and the downside before we get into almost telephone numbers, which, as I say, become all consuming then.
Thank you very much indeed, Jonathan. A couple of questions coming in about the quality of advice and financial advice. Sort of asking that, while some IFAs provide incredibly good advice and make sure that members truly understand the issues, others, to quote our questioner, treat individuals as simpletons rather than actually get them to understand the issue. To what extent, even among qualified advisors, do you think there's that sort of mix of quality of advice, and how do you sort of really design a sort of a process where individuals really get sort of that best quality advice? Jonathan, I'll go to you first, please.
Yeah, so the key thing here is looking at the what the employer or the trustee is going to do. So I would say best in class now, they are actually going out, looking for advice firms, doing their due diligence on those advice firms, and they're effectively looking at things, not just do they have national coverage, for example, assuming it's a firm that needs national coverage, but they're also looking at compliance records. They're also looking at regulatory records. They're looking at things like compliance check-in. So, for example, are 100% of all cases compliance checked before any transaction goes through, which is relatively rare. The way most advice firms work is that they will transact and then they will do sample check-in post-transaction. But of course, it's pretty obvious to see what the downside of that methodology is. Employers and trustees that are looking at this often look at that. The other big thing as well, and I mentioned it earlier, is pricing. They will also look to negotiate a price, irrespective as to who's paying the money at the end of the day, whether it's the employer, the employee, or member, or indeed it's split between the two of them. The other key thing is that they should look for consistency, because what you don't want, if you've got two members of a scheme, and let's say that they had absolutely identical situations, what you don't want is one being advised one thing and another one being advised something else, so that, if you like, that house view of that advisory firm is also really important for consistency. So that is really the approach that, as I say, a lot of organizations that have already gone down this route, or indeed are in the process of. Those are the sorts of variables that they will look at. So it's a due diligence process, which is no different really to the process you would go through when buying any other service, when running a pension scheme. So, choosing an investment manager or choosing a pension administrator, etc.
Nim, do you have anything to add to that at all? Thank you very much, Jonathan.
Yeah, no, I'd agree with everything that Jonathan says there. It's another slightly difficult one for trustees, of course, because this is really very much of a new world for most trustees. There are really relatively few who have personal finance experience. If they're company nominated, they would tend to come from the finance or the HR area. Member nominated, they could be elected, they could be trade union officials. So very often trustee boards aren't terribly comfortable doing this sort of due diligence and may well seek support in doing it. As far as the quality of advice more generally is concerned, it's a little while since I've been out there supervising financial advisors, but I can certainly endorse that there's variability. And there has been in the past some absolutely terrible advice. I think as the rules have been tightened up, the worst advisors have, for the vast majority, now been squeezed out of the system. But there was some terrible practice out there. And I don't know how widely understood, for example, it is that there is lots of help for people. The FCA has published guidelines, questions to ask your advisor. There's lots of stuff out there. It's just a matter of signposting people to it if there isn't an employer-endorsed solution available to them.
Thank you very much indeed. Another question here, Jonathan. To what extent can and should trustees be recommending advisors as part of their process?
Yeah, so I think this goes back to the due diligence point, really. So it depends what you mean by recommending. I mean, I've seen, in fact, it has been quite common, and I know it still exists, where trustees will point individuals to directories, for example. I won't name any of them, but there's one that I know a lot of trustees point members to, and yet those directories are effectively run based on how much money effectively the advertiser, because that's what they are, the advertiser pays. So I think the first thing is depends on what you mean by recommended. But if you're putting something on pension materials, saying even go to a directory, I think it's important that trustees understand how those directories work, because it does not make, the person that's going to come out at the top of the list is not necessarily going to be the best advisor, even with the most appropriate qualifications. What they will be is the advisor who's paid the biggest advertising fee. So I think that's one of the first things to be very aware of. I think in terms of more general, then I'm not sure trustees do recommend per se an advisor, and if they are, then they should have gone through that due diligence process. The same with any other service that they would buy in. So that goes back to my previous point. But yeah, recommending an advisor, I don't know, just because you know someone or someone's said, oh, they seem quite good, and then putting it in your pension materials without any DD, I would say is a fairly dangerous thing to do. Just because you don't even know they've got the qualifications you need. If you're running a DB scheme and it's people that want DB transfers, and no one in that firm has is a pension transfer specialist, then it's not really going to be very helpful.
But schemes can, if they go through that due diligence process and look through it, they can sort of have a sort of recommended advisor for the scheme.
Yeah. Oh, absolutely. Because we mustn't forget that at the end of the day, it's the advisor giving the advice to the individual who is responsible for that advice. Yeah, absolutely no issues. It's just making sure that they've safeguarded regarding making sure they've taken on an appropriate advisor in the first place.
Thank you very much indeed. Thank you. Nim, another question here. There are increasing calls for the regulations to change to enable trustees to block transfers if they think there's a risk of a scam. Our questioner says this sounds sensible, but do you see any risks in allowing this?
The obvious risk is that where there is a case to transfer and there isn't a scam, then you're depriving people of their own money. After all, this is their benefit, it's not the scheme's benefit. And the whole reasoning behind the regulations is that people can transfer if they have a legitimate reason to do so and the various criteria are fulfilled. It's been incredibly difficult for trustees, and the British Steel case just brought that absolutely to the fore, that there are people out there who are trying to steal scheme members' money. I think certainly the Pearson scheme, and I think schemes more generally, have instituted more checks, and if anything, they've had complaints from members that transfers haven't been able to go through fast enough because of the checking process. But a right to block, I'm not sure. I think it's very balanced, but on that balance, I would not be in favour, I don't think.
Thank you very much indeed. We're coming to the end of our webinar for today, but just to conclude and wrap things up, I was hoping to ask each of you to sort of leave us with your concluding thoughts. I have to start with somebody first. Nim, can I start with you, please?
Thank you, Jonathan. We started with COVID, so I think perhaps I'll end with COVID. I mean, I think COVID has been accelerating a lot of things in all sorts of areas of life, and pensions are maybe very much within that that movement. So some people having to retire earlier than they expected, taking their pensions, needing the money. For others, there's been time to plan and think a bit more while they've been on furlough or at home. There's been the move to digital, a lot of online training and seminars, retirement seminars moving online, and I think maybe narrower horizons for everybody. So for me, I think the current environment teaches us that we have to always be aware that unexpected things might happen, and that's very much the case in pensions planning as it is in all areas of our lives.
Thank you, Nim, very much indeed. Thank you. Jonathan?
Yeah, I think my concluding thoughts are really around complexity. So I think today has shown just how much complexity there is in this whole area, and we know that for the average pension member to understand this without help is never really going to happen, and yet they are making massive decisions when they get to the point of retirement as to whether they should be transferring that DB. If they've got DC, how should they be taking that DC, understanding all the implications of it regarding tax. So I think it's really about having a process in place. Now, I think for an employer or a trustee, those processes can be different. They don't all have to be identical, but I think there should be a process in place, because what we're really after here is good outcomes after 40 years of savings. What we shouldn't be setting as the bar is just that minimal requirement that's regarded from a regulatory perspective. We should be able to do better than that for members that have saved diligently for 40 years. So I would say let's have a process put in place.
Jonathan, thank you very much indeed. All that remains for me to do is thank our participants, Wealth at Work Director Jonathan Watsley and Pensions Retirement Specialist Nem Maradas, for taking part in our webinar. Thank you very much indeed, both. And to thank all of you for listening in. I hope you found it useful and informative, and look forward to seeing you at our next webinar once again soon. Thank you very much indeed. Thank you.